on account of the still volatile international environment. Inflation could turn out to be lower if the rise in US tariffs reduces demand for euro area exports, and if countries with overcapacity increase their exports to the euro area. Moreover, a stronger euro could bring inflation down further than expected. An increase in volatility and risk aversion in financial markets could weigh on demand and thereby also lower inflation. By contrast, inflation could turn out to be higher if more fragmented global supply chains pushed up import prices, curtailed the supply of critical raw materials, and added to capacity constraints in the euro area economy. A slower reduction in wage pressures could delay the decline in services inflation. A boost in defense and infrastructure spending could also raise inflation over the medium term. And extreme weather events and the unfolding climate and nature crisis more broadly could drive up food prices by more than expected. Turning now to the financial and monetary conditions. Market rates have increased since our last meeting. Bank lending rates for firms have been broadly stable since the summer, after falling in response to our policy rate cuts over the previous years. In October, they stood at 3.5%, unchanged from September. The cost of issuing market-based debt was 3.4%, also close to its September level. And the average interest rate on new mortgages, again, held steady at 3.3% in October. Bank lending to firms grew by 2.9% on a yearly basis in October, unchanged from September. Corporate bond issuance rose by 3.2%, broadly unchanged as well. Mortgage lending strengthened, growing by 2.8% after 2.6% in September. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks are resilient, supported by strong capital and liquidity ratios, solid asset quality, and robust profitability. But geopolitical uncertainty and the possibility of a sudden repricing in global financial markets pose risks to financial stability in the euro area. Macroprudential policy remains the first line of defense against the build-up of financial vulnerabilities, enhancing resilience and preserving macroprudential space. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And today the first question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon and thank you. Two questions, President Lagarde. The first one is about interest rates. And the question is, are we still in a good place? Whenever the interest rate moves next time, is it more likely to go up or down? Do you have clarity on that? Second question is about economic growth. Given your second straight fairly large revision in the growth outlook, is this just simply resilience to uncertainty, or should we be rethinking our entire assessment of the growth profile? Are we catching perhaps a windfall from the AI boom? Are firms more resilient and adapting to the new reality better? Is there some fundamental change about growth, or is it just a one-off improvement?
Well, thank you very much for your two questions. I'll try to unpack because there's a lot there. On interest rate, we reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold. But there was also a unanimous view that all optionalities should remain on the table, and that we would stick to the meeting-by-meeting, data-dependent approach with no rate path set and no set date for any move. And it was a unanimous view around the table. So I think that addresses your first question. Your second question is always an interesting question from you, but it's an interesting question because it raises issues that we will probably review in deeper details at our February projection next exercise, because we will also be looking at the surveillance report that we produce. We will be looking at the fiscal monitor. We might look also at the supply side review to go a bit deeper in some of the facts that would answer your question. We think that there is some change taking place in our economies. And if you look in particular at the drivers and what has surprised us on the upside, it's characteristically investment. And it's not just spending by the public sector, which there is, but it's also the private sector, the corporate sector, both large corporates, but also SMEs as well. And their investment, based on the data that we collect, based on the surveys that we conduct, is largely attributable to the development of AI. And AI takes multifacets, but certainly computer capacity, telecommunication, additional investment in intangible, more than tangible capex is really characteristic of what we are seeing at the moment. So that is something that we can already analyze, but I think we will be able to go a bit deeper in February, as we will see a bit of a longer interval to determine whether that's a long-lasting fact that is characteristic of this new growth. But that is clearly in play. The second one, which came as a bit of a surprise to us, is the contribution of exports. We had anticipated that exports, particularly out of the chemical industry and out of Ireland notably, but not only, would really correspond to a build-up of inventory and to a front-loading in the early months after the decision to increase tariff, or pre-decision to increase tariff. Well, that has been sustainable. And the contribution of exports has surprised us on the upside. So we don't know whether it's entirely attributable to the weight-losing drugs that are largely exported, or to other phenomenon, but the contribution of export has surprised on the upside, when in fact we believe that trade is more likely, as a result of tariffs, to be a drag on growth going forward. So that's also something that we will be attentive to. Thank you.
And the next question goes to Annette Weisbach of CNBC, please. Annette.
Thank you very much. President Lagarde, I have a question as well, going back to Isabel Schnabel's comment on the rate hike. Are you as comfortable with how the market is pricing in the current rate expectation as she is. Second question is on the fiscal stimulus in Germany. We were waiting for that for this year. Now there's hope it comes next year. What is your assessment, what it does as well to other countries in your area when it comes to the growth outlook for the whole? Thank you.
Well, thank you very much for your two questions. Certain things have changed and others have not changed. So when we look at activity, we have upgraded our projections. They've moved to the upside across the projection period. When we look at inflation, we've also increased our inflation projection for 26, and we have taken into account the movement from 27 to 28. So there are lots of things that have moved in that respect. One thing that has not changed much at all, and which, if anything, may have actually worsened, is uncertainty. And uncertainty is not a comfortable position. So I think we all suffer from that degree of lack of comfort. And we are all attentive to uncertainty, how it pans out, whether it's uncertainty related to geopolitics, whether it's uncertainty related to the movement of trade from countries with overcapacity in particular, what happens at the borders of Europe. So there are lots of factors that are in play and that will evolve over the course of 26 that are generating uncertainty. And as far as the future is concerned, as I told your colleague just earlier on, there was unanimous agreement around the table about the fact that all optionalities should be on the table and that we should stick to the meeting-by-meeting approach, to the data dependency, and we will be looking at all sorts of data in the field of wages, salaries, the decomposition of it. We will be particularly attentive because it plays a significant role in relation to services. And we do not have a set path for our rates going forward. I know this is, everybody would like some forward guidance, but we simply, in the current situation, with the degree of uncertainty that we are facing, we simply cannot offer forward guidance. Now, your second question related to government spending, public investment, and we take into account the documents that are filed by the various member states with the Commission to review the path of investments going forward. And we have an impact on growth for certain countries, Germany being, obviously one, in 26, in 27, and still a bit in 28. And so much can change in the meantime. But it does have an impact, and it is a driver of growth in the investment section that I was describing earlier.
And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thanks a lot. The first one, unfortunately, also on rates. The discussion today, was there any...
That's what we decided today, so you're right.
That's right. Okay, perfect. Was there any discussion about a cut today or about hikes today, just to have more clarity on the discussions today?
I don't have to wait for your second question. The answer is no.
Okay. The second question is on the revamp of the executive board over the next 2 years.
Revamp, you say?
The revamp, right.
Yeah.
That also includes your role in 2027. I know it's a long time off, to be honest, but there's already a discussion in Germany whether it's time for a German to become the ECB president. And just wanted to know if you think that it would be good after 25 years of the institution if a national from the largest euro area member states would become the ECB president. And as you already publicly said that Klaas Knot would be a good candidate. What do you think about Isabel Schnabel and Joachim Nagel, who both recently...
Okay, well, let me clarify one thing. I don't have any favorite candidate, and I did not say that Klaas Knot was the good candidate. There are plenty of very good candidates, and Isabel is one of them, but there are plenty of them, and I'm sure that there will be more in the future. Why not? I find it terribly... satisfactory in a way, that so many people want to have my job. It's a great job. And it's one when you feel that you can actually matter and affect the life of people and try to deliver for the European Union and for our currency, the euro. But as to who it is, what nationality, it's not, I'll have nothing to say about that. It will be for the European Council, and the decision will be made outside this beautiful institution. So whatever they decide. But thank you. You have still a long time to ask all those questions, huh? Phew.
Next question goes to Aude Kersulik of BFM Business.
Thank you. Good afternoon, Mrs. Lagarde. The euro's nominal effective exchange rate is at record levels. I know it's not a part of your mandate, but has this point been discussed by the Governing Council? And second question, still regarding to currency, how do you balance the benefits of a strong euro for import prices, good for your mandate, with the risk of a greater exposure to China, which is an important issue for Europe at the moment? Thank you.
Well, thank you very much for your question. I might give you the answer that you expect, which is that we do not target exchange rate. And we do refer to exchange rate in the risk section of our monetary policy statement, if I recall, when we refer to a possible higher exchange, an appreciation of the euro. So I'll refer you to that section in the risk segment of the monetary policy statement. And obviously it is something that we look at carefully as we look at the way in which currencies are positioned around the world. And obviously the current situation of the renminbi is one that we pay attention to, yes.
Next question goes to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks for taking my questions. I have one question on inflation. The higher inflation in 26 was justified or explained with higher services inflation. It's gone up to 3.5 in whatever it was, November, up for and it was on an upwards trajectory in the past few months. How concerned are you about service inflation overall? Could this be kind of turn into a nasty surprise? And my second question again is on ECB succession. One of the sitting members of the executive board has basically showed interest in becoming your successor. What's your reading on the law in terms of, is it possible legally to appoint a sitting member of the executive council as ECB president? Because as far as I understand it, it clearly says terms are non-renewable. And would that be in line with the law and also in line with the spirit of that rule, which I think is intended to kind of prevent governing council members or executive board members to kind of jostle for their next job in their current job? Thanks.
Thank you for your two questions. On your first question, thank you for focusing on inflation on services, because it's clearly one domain that we will be attentive to going forward. So you are right that service inflation has increased. It went from 3.2 in September to 3.4 to 3.5. So there is a trend that we look at carefully. A lot of that is related, based on the staff study, is related to wages. And wages have surprised us to the upside. If we look at compensation per employee, for instance, we are at 4%, which is more than had been anticipated, in particular in the September projections. So with wage having increased more than anticipated and being a strong contributor to most activities of services, not all of them, but most activities of services, it's hardly surprising that services inflation is higher than anticipated and contributing to the current inflation number that we have. It's balanced out by goods, as you will have seen in the monetary policy statement, is they go in opposite directions. Goods go down, services increase, and we anticipate two things in relation to that. Number one, that wages will follow a slightly declining trend going forward, and we have wages slightly below 3% at the end of 26. And that is based on measurements instruments that we have, whether it's the wage tracker, which incorporates all the negotiated, the collective bargaining agreement that are negotiated and which roll out into either 1 or 2 or 3 years, depending on the countries, and under which we cover now 8 countries with quite a large number of employees, workers, or whether it is the surveys and the corporate telephone survey that we conduct asking, corporates, where do you see salaries, where do you see wages, how are the negotiations going? So on the basis of all that, we believe that this compensation per employee should decline in the course of 26. But we are attentive because while we believe that a lot of the catch-up, for instance, has taken place, a lot of the one-off specific payments have occurred, we were surprised between September and December in our projection, and that is reflected in our numbers. So we are humble. We look at as many details and data, and we look at the vacancy, of course, to see what's likely to happen. We look at PMI numbers, but that's where we are, and it's a big contributor to services. And we have, because this is one that we really debated quite a bit and that we looked into, and that staff is working really hard to get to the bottom of it. Services is a big package. You have lots of things in there. You have accommodation, transportation, telecom, IT, financial services. There's a lot in there. And some of those subsectors of services are labor intensive, are wage intensive, others less so. So we have to sort of balance out and distribute the wage increases that we expect in between all that. But there is really a solid work done in that respect. So your question is, can a sitting member of the executive board be eligible for another board position or the position of president of the executive board? This matter was looked at in the past. It was looked at when Christian Noyer, the then vice president of the ECB, was possibly considered for presidency. It was looked at for Benoît Cœuré, who was then an executive board member and who was also considered possibly for the replacement of Mario Draghi. I think in both those instances, the determination by the jurists, the lawyers of various corners of Europe was that it was not possible. But I think the matter needs to be looked at again in order to ascertain, what is possible, what is not possible, what are the conditions. And it's not for me to pass a judgment on that. I think it needs to be cleared so that everyone knows where to stand.
The next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. President Lagarde, I have 2 questions on financial stability, as it was also mentioned on the statement. So financial stability and the international role of the euro could be threatened by the reparations law for Ukraine using the cash balance of Russia's asset. However, so far, the euro has been quite resilient in spite of Putin's retaliation threats. So what is your assessment of this kind of resilience of the euro so far in this respect? And also on financial stability and the digital euro project, which is making progress. The council orientation these days is a milestone, and the digital euro is viewed more and more as an anchor to strengthen financial stability in the euro area. So, in your opinion, could the ECB become a role model in the world to assess the importance of central bank digital currencies? Thank you.
I think I'll start with your second question. I know these are important moments for the digital euro because we have done our work, we have carried the water, but it's now for the European Council and certainly later on for the European Parliament to identify whether the Commission proposal is satisfactory, how it can be transformed into a piece of legislation or amended. Our ambition is not to be role models. Our ambition is to make sure that in the digital age, there is a currency that is the anchor of stability for the financial system. For the moment, that anchor is central bank money, which essentially has material form. It's the banknotes that you have in your wallet. But in the digital age, it has to be a digital expression of that sovereignty and a digital anchor for the purpose of the financial system that we have. So that's what we're pursuing, in addition to making sure that it is user-friendly, not costly, fast, efficient, private, that it can work online, offline. I mean, I could go on and on because you know that I've followed that very carefully with my Italian colleagues, and both Luis and myself are very strong supporters of this initiative, and we place great hopes in the work that will be done in Parliament once the Council has made its view, has determined its views. You know, on the other topic that you raised, I'm not going to expand on this matter because it's something that is under review, that is under work at the moment, which is of the competence of the European leaders and which is the expression of foreign policy. So it's not for a central bank to have either political views or central bank's choice as to what is appropriate or not appropriate. Our job, and we are trying to do it as much and as well as we can at the odd hours of the day or the weekend, is to respond to the request that are put upon us to determine that whatever choice is made by the leaders is going to respect the treaty, is going to respect the international rule of law, and will not damage financial stability. This is the remit of what is our duty. Beyond that, it's something that is outside our remit. Thank you.
And now Jan Malin of Plato. Jan, please.
Thank you for the opportunity. Madame Lagarde, I have a follow-up question on your first comment about the changing growth profile and due to AI. Isabel Schnabel made a similar comment in her interview with Bloomberg, where she said that the natural interest rate might rise because of that. Do you agree with that assessment? And my second question is on stablecoins. They have gained significant importance globally, but many experts see this as a threat to Europe's monetary sovereignty and are calling for stronger support for stablecoins in Europe as well. What's your position on that? Thank you.
Sorry, I just want to clarify your second question. You don't say that the digital euro is a threat to sovereignty. You said stable coins, right?
Stable coins,
okay,
yeah.
Okay,
yeah.
I had misunderstood.
Oh, okay, sorry.
Yeah, no.
Thank you.
My mistake. So, we are lucky in Europe to have something that is called MiCAR, So it's the legal framework within which instruments like stablecoins can work and can be supervised and can be regarded as safe. So our view is that an instrument that is in compliance with MiCAR is an alternative form of payment, which might have its benefit, might have a business case for those that issue the stable coins. My concern, because I have a concern, so that's, to the extent that it conforms to MiCAR, that it is properly organized, that it has the right one-to-one guarantee for the users, I don't need to have a view. Supervisors need to have a view. Those who control that there is actually the reserve. Where I have a concern is when you have something that is getting a bit technical now, if we go there, is the situation of multi-issuance currency for stable coins. Because without going into the details of how it is structured, it exposes the reserves, the resolution mechanisms, and the redemption mechanism in Europe, as is organized under MiCAR, to other currencies under which the stablecoin would be issued, and which could be a threat and a drain on the provisions of MiCAR that apply in Europe. So on that particular area, I think that we need to be extremely attentive to what the potential risks are for the system itself and for the holders of stable coins. On your first question, look, I'm not going to agonize over the issue of, where and how is the R star and the rate which is ideal because it neither stimulates nor restricts our economies. There are multiple factors that can affect it. Productivity is obviously one of them. If we draw a lot of productivity out of artificial intelligence, it will impact. But there are multiple other factors as well that will impact R star. And one of the characteristics of R star is that you can only sort of identify it eventually in completely stable circumstances. I don't think that we can call the current circumstances as perfectly stable and predictable. There is, as I said earlier, too much uncertainty, too much risks, and too many shocks under the spell of which we still are to actually identify R star and have a view as to whether it's going to increase. So, as I said, it's not observable, so to speak, and I think it's a very good debate to have, but I'm not sure that this is the one that has caught the attention of the Governing Council. It's certainly not one that we debated today, or yesterday for that matter.
And the last question goes to Philippe Lacour of AFP. Jean-Philippe.
Thank you, Wolfgang. Bonjour, Madame la Présidente.
Bonjour, Monsieur
We'll
Lacour.
switch in English, of course. I have two questions on the same issue, if I may. It's related to Ukraine. You know that in these hours, the 27 head of states meet in Brussels with a bold agenda. And one of the points is to try to agree on this reparation plan for Ukraine. So a single question is, are you confident that they will succeed to find a solution? And the second one is, earlier this month, yes, ECB said we cannot provide a backstop for, to use the frozen Russian assets to finance Ukraine. Simple reason, it would likely breach the treaty, prohibiting monetary financing is the other point. But in these several times, shouldn't the overriding interest of the people of Ukraine to have the right to rebuild their country and live in peace not come above all kind of purely factual legal considerations? And as you say before, for the case of Mrs. Schnabel, would it be possible to maybe look at again, if the question is again raised? Because, I mean, there is overriding interests of the people of Ukraine that may be, above the pure legal considerations. So I would like to have your point on this.
Well, thank you for your question. Your first question, there is work going on at the moment. Again, it's not our remit, it's for the leaders to decide. And given the importance of the matter, given what is at stake, I am fully confident that they will find a solution. It might be in the usual European way, you know, going in circles and being time-consuming and giving rise to a lot of speculation as to whether it will work, it will not work, there will be one camp or the other. But I'm confident that they will find a solution because it's too important. You know, we are an area of the world which praises itself for respecting the rule of law. And this is one of the characteristics of our democracy. The leaders will decide, okay? And I'm sure that there are solutions that can be debated and discussed, and there are constructions that can be elaborated. But it is not for the central bank to actually encourage or support a mechanism under which we would be called upon and scheduled to breach Article 123 of the treaty. This is, you know, monetary financing is not allowed under the treaty. You cannot expect me to validate ex ante a mechanism under which there would be monetary financing. This is pretty obvious. Thank you. And if there is no more questions, then I'm happy to wish you all a Merry Christmas, happy holidays, whatever is convenient, to those of you who celebrate or don't celebrate. And we look forward to seeing you in the new year, bright and ready. And
that was ECB President Christine Lagarde speaking in Frankfurt. This is Bloomberg Open Interest. I'm Matt Miller alongside Dani Berger. She's back.
Yes, I would also like to wish a Merry Christmas, Happy Holidays, whatever is convenient to everybody out there.
Happy Hanukkah, Kwanzaa, all of the holidays that are in the next
what a great note to
few
end
months.
On from Madame Lagarde.
In terms of what they did or didn't do, it's more interesting, I think, what they didn't discuss. They didn't even debate the neutral rate.
Right.
They didn't talk about a hike.
Or a cut.
Or a cut.
Has to be like the most boring meeting ever that they all sat around. They're like, so we're going to hold? Yep. Okay. See you all in a couple months.
No talk about a digital currency. That's a matter for Parliament or for the European Council.
Right.
Yeah, they just put a lot of things, I guess, off.
Yeah.
You know, and she's not giving any forward guidance.
Nope. She's being very steadfast about that, saying that what they did agree on was that they're taking it meeting by meeting, and that's exactly what we're getting from ECB's Christine Lagarde.
We got a cut from the Bank of England.
Yes.
We've had a lot of central bank action. We still have a lot of central bank action this week, but it's interesting. We have had a tough time in stocks here in the U.S., 4 days in a row down, but markets are up today. You can see futures are higher on the S&P. Futures are higher there on the NASDAQ. If you look over in Europe, the Stock 600 also hitting new all-time highs. I'm told by a trader, one of my buddies messages in, hey, we're at new all-time highs here. So there is a lot of optimism out there.
There is, and that's thanks to CPI. We're going to talk about that to Michael McKee in just moments, but core reading coming at 2.6 versus 3%. You add to that Micron earnings, and that is the rally that we have underway. By the way, let's get a check on Micron because shares are up 16% 5 minutes into the open. It boosted tech sentiment with a rosy forecast. Revenue blew past estimates on its strong demand and pricing power, saying that there is more demand than they have supply, completely reversing yesterday's narrative, which was, oh no, Oracle's not going to get funding. The AI house of cards is going to fall.
All right, we also had, I think, really a fascinating merger of equals story out this morning. You may not know how much faith I put into mergers of equals.
Spoiler, not a lot.
Very little. But Trump Media agreed to combine with TAE Technologies in an all-stock transaction valued at more than $6 billion. The two companies say it'll create one of the first publicly traded nuclear fusion companies, with plans to construct the first utility-scale fusion power plant next year, which is amazing because nuclear fusion has never been achieved to create energy. It takes a lot more energy to heat up the thing than it does, than it gets from the thing producing.
Let alone...
Like over 100 times in the most successful nanosecond experiments.
Okay, and so I don't know why a media company would have any more luck at doing that upon a merger, but an interesting one nonetheless.
Yeah, I think fascinating, and we're going to talk to Will Wade about that later this hour. Underlying U.S. inflation, as Dani mentioned, rose in November at the slowest annual pace since early 2021, an unexpected improvement following months of stubborn price pressures. Let's break down the data, which could be considered noisy, with Michael McKee, Bloomberg's international economics and policy correspondent. I say that because rent and housing costs were assumed, to be zero in October?
Yeah, the whole thing is kind of weird. And when you look at the release, it's mostly just blank spaces. So you have to impute a lot. It'd be like saying, well, the stock market's up today, but we can't tell you what stocks have actually moved. And that's the situation here. We do have they did get some numbers because they were non-government collected numbers, numbers that companies sent in. As Dani mentioned, the core, a big drop to 2.6%. Headline also dropping to 2.7%. Food at home, 1.9%. Now, these are year-over-year numbers that are 2 months. So in the 2-month change from September to November, we see food at home move down to 1.9%, gasoline up just 0.9%, and used cars still rising in price. Now, the caveat that Matt mentioned is the owner's equivalent rent dropped during the 2-month period, but to get that number, according to the folks at Inflation Insights, Omer Sharif, you'd need to have a zero increase in October, which is just not possible, he says. So do we trust this? We don't know. It's also true that with the late data collection might have been biased by holiday sales because we got to the end of November and, of course, everything is on sale for Black Friday. Other mostly good economic news out today. Initial jobless claims fell. Continuing claims were only up a little bit. The Philadelphia Fed headline number was worse, but the prices paid numbers and employment numbers were better. So all in all, you look at this and you can see why maybe the market's excited for today, but I don't know how much weight you can put on any of this at this point.
All right, Mike, we're going to talk to you again in about a half hour's time. Because it does...
Happy Festivus. I want to join in with you.
For the rest of us.
Yeah.
If you know that.
It's Seinfeld, thank you.
I
do know it, yes.
Good. Let's bring in Morgan Stanley's Chief Investment Officer, Cross Asset Solutions. Jim Caron joins us. Jim, great to have you here on... I mean, there's so much news, which is weird, just a week ahead of Christmas, but we have rate decisions, we have Micron out with great earnings, which helps obviously the AI sector. We have inflation that's better than expected. What do you make of it?
Yeah, it's a good question. There's a lot to sift through, but I think it's important not to lose track of the bigger picture and the trend. So the information that I'm getting today, let's start with the ECB. The ECB is saying, listen, we expect there to be better growth and inflation is pretty close to target, so we don't necessarily feel as though we have to continue to add accommodation. The Fed is adding some accommodation, and the inflation rates have been coming down. Now, maybe that's more noisy, but essentially what we're starting to see is basically what looks like higher productivity in markets going forward. So what we're saying is that we're getting decent growth expectations in the future, but we're not getting a lot of inflation that's being associated with that. So it's enough for central banks to readjust their rates, get to where they need to be, but we're starting to see the early signs of what a CapEx-led recovery cycle looks like, which is what we're in right now, alongside higher productivity, which means you get higher growth with lower inflation. And so all of the issues that we've been discussing and talking about is really positive. It's a really positive backdrop for earnings and earnings growth and earnings potential going forward into next year.
Jim, does that mean that this yield curve steepening, which we've been witnessing over the past month or so then, is overdone if that threat of inflation is somewhat diminished by the productivity gains?
You know, that's a really good question, because I do have a view that the yield curve can continue to steepen, but a little bit. Meaning that if I'm looking at 10-year treasuries somewhere around 410 to 415 in yield, could yields go higher if you get better economic activity and maybe the Fed doesn't have to cut rates as much? Sure, absolutely, that could happen. Maybe 10-year yields go to 425, maybe they even go up towards 450. But if we're in the backdrop of a relatively stronger economy that can support that movement higher in yields, then that yield curve steepening is actually another component of stimulus going forward. A steeper curve is usually a positive sign for forward earnings and for future growth.
Is this stimulus that we're going to get? I mean, one big beautiful bill is cited a lot, but we've also heard now from President Trump last night about checks going out to members of the military, the warrior dividend, he called it. There's another $2,000 that he wants to give everybody, I'm assuming on the lower end of the income spectrum for health care. Is that going to, combined with the faster growth and lower inflation, help take care of the K-shaped economy concerns that we've heard so much about this year?
So, you know, so this is what the market's trying to figure out, and there's a lot of speculation here. But let me pose this: what if it works? I mean, I know I watched President Trump last night on TV, and I know it's largely about messaging and things like that. But what if he's somewhat correct, and what if it does work? What if you do get this movement towards higher demand, higher consumption, that there is a dividend from some of the, you know, tariffs, that it is able to support that bottom part of the K during this soft patch that we're going through in 2025 and is likely to spill over into the first, let's say, half of 2026. So we get that fiscal stimulus from taxes and everything else that can support the lower end of the economy to keep that consumption high and keep that demand, so that in the second half of 2026, which is really when we expect all of these policies to really gain traction in terms of investment, in terms of hiring. We expect the jobs market to really start to recover, really starting at around June. If that starts to happen, then you are likely to see a more higher pressure economy going forward. And certainly the Fed will not be cutting interest rates in that environment. But before we get there, we may get one or two more cuts first.
Jim, this just brings me right back around to the confusion of the direction of bond markets from here. JP Morgan did this survey where it basically said that a lot of retail investors are moving away from structured products like 60-40. Instead, what they are doing is they are constructing their own equity portfolios, just equities, so being very over allocated there. And then for a hedge, adding in something like gold or something less traditional, basically anything but bonds. What do you make of that as a sort of portfolio construction, maybe just on its surface, and the risks of that into 2026?
So this is a theme that we've been talking about for several years, moving away from the 60-40. The 60-40 portfolio works as a passive investment when you have a steadily declining interest rate environment and bond returns are very, very stable. That's not where we are today. Bond yields are likely to move sideways over the foreseeable future, which means they're going to cycle with equities, which means that bond returns are going to be more correlated to equities. So we need to find a different solution. So the way that we start to think about markets is in much more of a thematic way. We're doing a lot of the same things at Morgan Stanley Investment Management, where we're creating baskets of equities to play certain themes in the markets, like policy-driven initiatives that's driving cash flow, that's driving sectors and driving industry and driving companies. Looking at AI and how we play AI beyond just buying semiconductors, but thinking about the beneficiaries, and creating a structure and a portfolio that manages the risk, similar to what a 60-40 is supposed to do. And certainly bonds are included in this, but it's not as easy as just saying 60% passive equities, 60% passive bonds, and that's all you need to do. It's really about being a bit more thoughtful within the portfolio construction. Now, whether that's adding a little bit of gold, sure, there's nothing wrong with that. Also adding a little bit of inflation protection. But at the same time, why not start to look at value and quality stocks that are adopting AI technology that is likely to unlock economic value in the future and is being supported by government policy, taxes and things like that. And let's combine that together and construct a portfolio. And my view and our view is that we would have a more durable portfolio with good returns and lower risk.
Jim, it is going to be an interesting 2026. I think that's fair to say. We're looking forward to having more conversations with you in the new year. Morgan Stanley's Jim Caron, thanks so much for joining us this year. Coming up on the show, Micron's strong demand and pricing power for its memory chips is giving it a boost on Wall Street, lifting overall markets. We'll have that story coming up next. You're watching Bloomberg Open Interest.
Micron's upbeat outlook is convincing Wall Street. The memory boom is stronger than expected. Bank of America is raising the company's shares to a buy. Morgan Stanley said Micron's earnings are rising so fast and look so durable that valuation worries aren't even meaningful. Let's dig into Micron's results with Bloomberg Tech co-host Caroline Hyde. And this is, I think, one of those things that's gone from super boring to absolutely fascinating, right? From commoditized DRAM to high bandwidth memory. What's the story?
AI is the story.
Yeah.
And the ever needing infrastructure that actually really is focused on high bandwidth memory, which only has a few players involved. Micron has been leading here in the United States, SK Hynix over in Asia, Samsung's desperately trying to play catch up. But basically already the CEO is saying, I'm sold out for fiscal 2026 already. That gives such pricing power. You're also getting pricing power, though, even in the PC part of the business, the more boring part of the business, the NAND part of the business, because that too is now suffering supply issues because everyone's focused on the high bandwidth memory. So Micron is up 200% this year alone. It's not even at a record high that was touched earlier in December, but you're seeing just market cap spiral ever higher and people really feeling resilient. Like analysts, only one says sell, nearly all of them say continue to buy. And in fact, we've got one analyst, Rosenblatt, saying this could go as high as $500. You're currently at $257.
I wonder if that sell analyst is getting some angry phone calls this morning. I think the point about PCs and smartphones is super interesting because with AI, we've been talking a lot about this idea that it's crowding out energy usage, and that means people are paying more when it comes to electricity. So are consumers going to feel this as a secondary bite of AI, that all of a sudden your smartphone and maybe your PC are more expensive because the memory chip input into it are also getting more expensive?
It depends whether a smartphone maker decides to pass that on to the end consumer or sucks it up a bit themselves. But already you've seen Dell saying, I'm going to have to increase my prices. That was reported by a different outlet earlier last week. Why? Because of the price of memory is going up so much. This has been a pressure point on the likes of HP as well. But a lot of these companies are also trying to dovetail into the world of AI PCs. Now, I'm trying to work out who the end buyer for that really is. It seems to be a corporate enterprise that's going in first and foremost. But maybe you will be willing to pay that much more for an AI-enabled smartphone or PC, and therefore they can suck up that higher cost rate. But look, this is just a glorious time to be selling these sorts of chips. But what's interesting is this has always been a sort of higher, lower, really cyclical type of the business. This time, is it different? You always hear from Micron that it is. They're trying to build out. They're spending more on capital expenditure. They're raising it to 20 billion versus then 18 billion. That's up from about 15 billion for this year. They need to spend more to build out their supply. Like they're adding in Boise, Idaho. They're looking to build right here in New York, but that doesn't come online until like 2030. But again, it's all just, as you say, all areas of the economy that get so affected by this.
So true.
How much memory do we need for AI? And it's so fascinating because if you use ChatGPT, I'm just talking about on a consumer level, right? Or Gemini or any of these models, it remembers everything that you've told it and stores all the photographs that you put in. So,
and depending where they're storing it, are they using cloud? Are you going to do more on your edge computing? Are you wanting it to be done on your phone? That's sort of where many think eventually it will be done. Apple leads the charge there in terms of trying to give security to what you do. But yeah, these little bits of nano chips become ever more important.
Caroline, thank you so much. By the way, we're going to catch up in an hour. Word on the street is there's a fun rocket launch on its way. So we'll talk about that. We'll talk about that in about an hour's time. Caroline Hyde, also catch her on Bloomberg Tech, also in about an hour's time. Elsewhere, activist investor Elliott has built a stake of more than $1 billion in Lululemon. Joining us now is Poonam Goyal, Bloomberg Intelligence Senior Analyst for E-commerce and Athleisure. Poonam, it seems that the concentration of Elliott at this moment finds a new CEO?
Yes, I think, this is just positive reinforcement that a new leader at helm at Lululemon in 2026 will hopefully make the right moves to really put a product-led turnaround in place, because what we saw over the past few years has just been fueled by execution missteps that is actually causing Lululemon sales to turn negative for the first time since the pandemic in the fourth quarter of this year.
So what can they do? I've heard you, Poonam, in previous, over years, talking about ideas to make Lulu more profitable. One of them, I think, was maybe a skincare or some kind of lotion product that I'm not sure if they came out with. They went into or dabbled with shoes, for example. What else could Lululemon do in terms of product offering? Or do they just need to appeal again to like a higher income demographic?
Right now, I would not worry about them branching out into adjacent categories. The focus should be on turning the women's business around. That is where the pitfall has been, and that is where they need to compete more effectively, as competition has really encroached on their space. So they need to get product there right, and they need to get the marketing message out right, with women believing that Lululemon is still the best wear for them when it comes to performance and it comes to going out.
Poonam, yeah, but they still have, just quickly here, can they really overtake Aloe and Vuori too? 30 seconds.
I think they can. I think it's all about product. They have to show a material difference in their product. And if the product stands out, they can drive a turnaround. They do have the brand equity still in the consumer's mind.
All right, Poonam, thanks very much. Poonam Goyal there of Bloomberg Intelligence covers the retailers for us. Coming up in the next hour, retail goods, I should say luxury retail goods. Coming up in the next hour, Racquel Oden joins us from HSBC. She's overweight U.S. stocks as valuations remain below prior cycle peaks. Plus, we talked to about alternative investing in things like Hermes handbags with Luxus CEO Dani Auslander. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. We are undoing 4 days of losses with strong gains thanks to earnings and to the macro data.
Yeah, a soft CPI print offers some relief to investors, while Micron's upbeat forecast stems the tech sell-off.
Meanwhile, a nuclear power play, Trump Media will merge with TAE Technologies, a $6 billion deal.
And in banking news, UBS is set to begin its latest wave of job cuts in mid-January. We'll give you the details there. But we begin with the November CPI data that came in well below estimates. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. So, Mike, we're looking at darn near 2.5 here.
Yeah, darn near, if the numbers are correct, which is, of course, the question that a lot of people who analyze this stuff are raising right now. As you mentioned, big drops in the headline number from 3 to 2.7%, the core 3 to 2.6%. And we saw some categories with some data for the months because they did get information in from non-government sources. But in general, the numbers are just a blank space in most of the CPI report. Food at home, over 2 months on a year-over-year basis, up 1.9%, gasoline 0.9%, and used cars up 3.6%. Those are the ones that kind of stand out. Where the inflation is, goods prices up 1.4%. That's tariff-related, I would imagine, and services prices up 3%. That's the part that the Fed thinks is going to start going away. And they've been thinking that we might see housing costs go down. They've been expected to for a long time. The problem with this report is apparently they went down too fast. According to the CPI, the owner's equivalent rent measure that the BLS uses rose 3.4% in the 2 months on an annual basis after 3.8% in September. To get that, you'd have to have zero increase in October during the month, and that is kind of not possible, according to the folks at Inflation Insights. Joe Brusuelas writing in this is one seriously flawed report. So a lot of questions about this, and also the question that everybody has is late data collection. They had to collect to the end of November, got started halfway through, so did they pick up a lot of sales, the Black Friday sales and things like that, instead of what the prices essentially normally are during the month?
All right, Mike. Great to have you wrap that up for us. Thanks very much. Michael McKee is our international economics and policy correspondent. Let's bring in Racquel Oden, HSBC head of wealth and private banking, to talk about the effects of that on this market. And it's great for the Fed, right? They can continue to cut rates. It's great for this administration. That's what they want. It's good for the economy, right? If inflation comes down closer to the target. How do you view it?
So I think what's really important that we should continue to look at, I know people may be questioning, did it come down too quickly on the CPI report that we received today? But I think what's really important for all of us to always continue to pay attention to is wages. So wages are up around 3.5%. And inflation, whether it's 2.7 or 2.8, the reality is as long as wages are outpacing inflation, the Fed's actually doing their job. And that's always a good sign. So individuals are making more and inflation is still, wavering directionally more towards that soft landing of 2%.
By the way, as this demographic shift continues, that's just not going to be good enough, because the problem with inflation is that it robs savers. And we have more and more and more savers and fewer and fewer and fewer wage earners. So
I think it's a tale of two cities, as you just talked about. If you take a look at what's going on with inflation, right, directionally it's going in the right way. But the thing that's really important is that job market is still very soft, right? So if we take a look at unemployment, that did tick up. So it went from 4.4 to 4.6, which is the highest level since 2021. So as we continue to look to the Fed to continue the easing, we are still seeing soft job markets, at the same time inflation going in the right direction. But very important is we take a look at what's actually happening with the overall markets and corporate earnings, really strong. We're going to end the year at around 13% in corporate earnings. And as we all know, we've had all-time highs on the S&P, the NASDAQ, all of the above. The idea that that will carry into 26 is pretty important, as well as we do have to keep in mind there is a decision that needs to be made on a new Fed chair. But if we continue the easing of rates next year, and with what we're seeing, the exuberant level of what we expect from markets next year, it, again, should be a strong equation for 2026.
That exuberance isn't necessarily everywhere. And one of the sectors that's still up on the year, but not up as much, is a lot of the consumer sectors. Even just yesterday, you had General Mills talking about that they were going to cut prices on 2/3 of their goods in North America because of pain and consumers not willing to buy unless there's a sale. You had Lenner saying that they're taking more price cuts and offering more incentives, the home builder, for the housing sector. How much of that is going to continue into 2026, as specifically consumer-facing companies needing to look at margin compression in order to keep sales higher?
You're absolutely right. And do not forget the important component of Liberation Day and taxes. That has still not been resolved. And so as you think about these consumer product companies, they're going to start passing on those prices to the consumer, right? Their margins have been shrinking. They've held on to it. Because we haven't resolved it yet, at this point, the consumer will feel that. So in the short run, I will tell you, yes, there will be impact to the individual, quite honestly, in the short run. I will tell you, if you take a look at the markets and corporate earnings and what we should see from the standpoint of the IPO market and what we're expecting, will be strong results. So individuals will still continue to see a little pain. Let's see what happens with continuation of rate cuts. For the first time, we're now seeing the 10-year Treasury yield going down. So that's a good sign that we hopefully will start seeing cuts in mortgage rates for individuals, whether it's their credit cards, whether it's auto sale loans. So all of those things for the consumer are going to continue to be important for the Fed to continue to watch, to figure out if they need to continue cutting these rates next year.
So you do expect a lower 10-year yield. Right now we're looking at 4.11, 4.12, but it's still far higher than when the Fed started its cutting cycle, right? Since, I think, September of 24, the Fed's cut 175 basis points, and we're up like 50 on the 10-year.
Right. So that's why I said we have to continue to watch that. And so today's CPI report gave us the indication. Markets responded very positively. The 10-year yield started to come down, which kind of gives us the signs of what we are expecting the Fed to do in order to see that behavior happen. If inflation had come in what we were expecting, quite honestly, we weren't sure what was going to happen to the 10-year Treasury yield.
It was pretty incredible, though, to see markets trading at all-time highs with the rise in the long end.
Yeah.
If this was only a few years ago, we'd say those two things can't happen in concert.
I think there's a lot of things we would say that could not happen that have happened, right? And so the continuation of market volatility, that is a theme for 2025, guys. That is genuinely a theme that we saw all year long, which was volatility. At different points, whether it was tariffs as well as the government shutdown, let's not forget, two very historic things happened to this economy this year. But my optimism for next year is definitely U.S. equities continues to show really great signs. The sectors that we know will continue, at least from what we're seeing, I would say financials, based on what we saw in corporate earnings, as well as what we're seeing happening in the markets, and tech. I know we're all tired of hearing about it, but quite honestly, if we take a look at the importance of what is happening from an AI standpoint, three things are really critical in that. One, AI is going global. Let's keep that in mind. So I know everyone's talking about the AI boom and there's a bust, but if you think about the fact that they're moving into China, into Japan, and into India, it just shows you the demand for chips are now going to be a global demand, which is different than the demand we're already seeing here in the U.S. I've talked about this for a period of time, which is the broadening out of the sector of AI, broadening out of the tech sector. So I call it the forgotten 493. Mag 7 right now saw earnings around 20%. Next year, slightly down, like 18%. But what's really important is that forgotten 493, on average, they saw earnings around 2% this year. We're predicting 15% for those particular 493. So the ability to still find some really great gems, and I call broadening out of that sector, is really important if you think about the opportunities for next year.
Racquel, great having you in the studio. Thanks so much for joining us, and thank you for all that you've done with us this year. I hope you have a fantastic Hanukkah, Christmas, Kwanzaa, or whatever.
Whatever is convenient.
Whatever is convenient. Happy holidays. Racquel Oden there of HSBC. Let's get a check on what's going on in the markets right now. After 4 days in the doldrums, we're back up. Looking at gains in futures on the S&P. Sorry, futures. We're in the live cash trade. We're looking at gains on the S&P, 67.85. So we're still 116 points from the all-time high that we hit, 69.01 a couple of weeks ago. But it's better than a stick in the eye, as my stockbroker always says. We're up 1.5% on the NASDAQ, so it's really the tech stocks that are leading the charge today. And as far as the individual movers in the market, what are we looking at?
Well, we have Micron. I mean, that has to be one of the big ones. And it's part of the reason why, as Matt was just showing you, that the NASDAQ is outperforming. They delivered an upbeat forecast for the current quarter, saying that there was surging demand for memory chips, so much so that demand was easily outstripping supply.
Bloomberg sources say activist investor Elliott has built a stake of more than $1 billion in Lululemon. We were just talking about that with Poonam a moment ago, and that's been a boon to Lulu shareholders, now up 7%.
By the way, speaking of consumer stocks not doing well, here's literally the opposite of that. So try to paint whatever picture you can. Darden has boosted its full-year sales outlook. They're seeing strong demand for Olive Garden.
It's lovely.
And Longhorn Steakhouse. I literally cannot remember the last time I've been to an Olive Garden. Like, I was probably a child.
We should go.
Times Square Olive Garden.
I'll take you to the Olive Garden.
Times Square Olive Garden, $200 table at New Year's.
It'll be lovely. Coming up, President Trump defending his economic agenda in a primetime address last night. We'll break down those comments.
Plus, Trump media gets into nuclear fission. We're going to discuss its deal.
More importantly, fusion.
Did I say fission?
Fission is something that is possible, right? Fusion is a dream.
Okay. Fusion. We're going to discuss that deal and what it actually means for Philistines like me that don't know. TAE Technologies is what they're merging with. That's coming up next. This is Bloomberg Open Interest.
Here at home, we're bringing our economy back from the brink of ruin. The last administration and their allies in Congress looted our Treasury for trillions of dollars, driving up prices and everything at levels never seen before. I am bringing those high prices down and bringing them down very fast.
President Trump yesterday in a primetime address looking to reassure American concerns about the rising cost of living during, again, an address from the White House last night. Bloomberg Washington correspondent Tyler Kendall joins us now, who is live at the White House. Tyler, what did we actually hear from the president? Any tangible policy takeaways from that address?
Yeah, hey, Dani. Well, President Trump floated a few different policy ideas yesterday. Some were new, some were repeated, and some would definitely require approval from Congress. Perhaps the biggest, newest policy we heard was President Trump announcing what he is calling warrior dividend checks, which will go to U.S. service members, and he says is funded through tariff revenue. He says that the checks are already in the mail, and there is reporting that this money was already allocated and appropriated under the One Big Beautiful Bill. Beyond that, we did hear him preview that he's going to announce some serious housing cost reforms, though he declined to provide more specifics there. A lot of what we heard, though, was him touting accomplishments from this past year and how that could translate into next year. He says, even as we know that Americans aren't feeling that good about the economy, according to consumer sentiment readings and also polling. One idea, for example, President Trump re-upping the idea of tariff revenue rebate checks, but we know that that would require congressional approval, and I have to say, when I'm on Capitol Hill, you hear Republicans kind of shy away from the idea, saying instead they would want to see tariff revenue go towards paying down the national debt. Dani and Matt, I'll put one other issue on your radar that we could keep in mind, that we should keep in mind when it does come to how Congress could help President Trump with this issue on affordability, and that is, of course, healthcare, because today Congress is set to adjourn for the rest of the year, and they appear to be leaving town without a plan to extend those Affordable Care Act premium tax subsidies. President Trump did touch on the issue last night. He says that he wants to see a plan that would put more money into consumers' pockets instead of subsidies for insurance companies, but he did not endorse any of those plans that are brewing on Capitol Hill.
Do you, I mean, in the Washington Bureau, is there a fact-checking division? Because just that little snippet we heard where President Trump says inflation like this was never seen before is patently untrue, right? I mean, it's very easy to look back at CPI on the Bloomberg terminal and find many periods of inflation that were higher, much higher. You know, in the 80s, for example, inflation was in the double digits, which is something that we never reached during the Biden administration.
Right, exactly. It's always important for us to put President Trump's comments into context. Yes, we do, of course, have a fact-checking division here in Washington. And President Trump really tried to use this to compare himself to his predecessor. Another, of course, topic that he brought up was wages outpacing inflation, but it's also important for us to look at how real income growth is slowing. So just always trying to put these types of numbers into perspective, as President Trump is really trying to convince American voters that they should feel good about this economy, despite what the data and the sentiment polling is telling us.
All right, Tyler Kendall there at the White House. Thanks very much for that. Let's turn to a company linked to President Trump. Trump Media is getting into nuclear fusion, agreeing to buy, essentially, TAE Technologies. Dan Ives of Wedbush spoke with Bloomberg about the deal.
There's a winner in the U.S. and global nuclear fusion. It's TAE. So I think that's at the centerpiece of this whole deal. It's much more about TAE, in my view, than in terms on the Trump angle, the political backing.
Joining us now is Bloomberg energy reporter Will Wade. And Will, I won't ask you to make sense of a media company buying a company invested in nuclear fusion, but I did read that they want to start an actual nuclear fusion power plant next year. Is that possible?
I mean, it's possible, but let's just say this is not the deal I was expecting to see when I got to work this morning. They won't even be the first, actually. We have Commonwealth Fusion is already working on their commercial fusion power plants, but fusion power is still under development. We don't have anyone who's really got a working system yet, but there are a couple of companies that are getting close, and TAE is one of them.
Can I ask you to try to make sense of it? Maybe not in like a media combining with a fusion company, because again, maybe there's no way to actually make sense of this, but why TAE would look for a buyer outright, especially one with connections to the White House?
Money? I mean, I was just listening to the conference call, and the CEO of TAE, the first thing he said is capital is becoming one of our biggest problems, which is interesting because in fusion, physics and engineering has really been their biggest problem. But they're getting up to $300 million cash out of this, so that's a good start for them, and they could always use the money.
From what I've read, the most advanced scientific efforts to extract energy through the fusion process have used over 100 times more energy to do the experiment than what they've gotten. So how does that make any sense? Like, how could we go from that to one that works next year?
So yeah, that's the key benchmark that fusion companies use. They can create that fusion reaction, which generates electricity or generates energy. Well, it's heat actually, but they need a lot of energy to make that happen. So what we saw in 2022 in Lawrence Livermore Labs in California is they finally had a reaction that generated more power out than power going in to make it happen. So that's what all of the companies have been trying to do, is to consistently have that more power out than going in reaction. And we have not yet seen that on a commercial scale.
So on TAE, you have a company that has yet to realize its promise. In Trump Media, you also have a highly unprofitable company too.
So it's perfect.
It's maybe in that way it's perfect, or maybe in that way it's just a lot of hopes and dreams pinned on this thing. Is there a realistic timeline for fusion? What would that look like? Not even to get it up and running, but to have a company profitably be executing on it?
Well, their CEO said today he expects first to power 2031. I'm not quite sure exactly how he's measuring that, but that was the phrase he used. But yeah, I think we have a couple of companies that could realistically be delivering fusion in the 2030s, mid-2030s. We've had more optimistic timelines that they've shared with us in the past, but you know, you want to be skeptical on this because it's very hard to do.
All right, Will, it's great having you on the program to clarify, and I'm sure we'll be covering this more over the next 40 years. So stay with us for that. We'll wait on nuclear fusion.
Yes, perfect timeline. Okay, coming up, speaking of 40 years, actually, I swear this will make sense. Boomboxes, nose rings, Danny DeVito, Steve Schwartzman trying to DJ. Buckle up for the most expensive midlife crisis on Wall Street as Blackstone drops its annual holiday video for their 40th year anniversary. That was my segue. Stay with us for that. This is Bloomberg Open Interest. Is it the highlight of your holiday season? The thing everyone has been waiting for? It is Blackstone's annual holiday video. It's back, and this year the firm's 40th birthday sparks what they label as an over-the-top midlife crisis.
Turning 40, it's a really big deal.
Did you get a nose ring?
I've always had this.
Some of us are in denial that we've become a mature organization.
Hey, guys, let's start buying sports teams.
Okay. We could buy Ferraris.
No, let's buy Ferrari.
Yes! Yeah, we're definitely having a midlife crisis. Wait, are we rolling?
Even Steve's going through it.
Well, I was thinking of becoming a DJ.
Steve Schwarzman, a DJ? He'd crush.
I can't believe they got Solomon to agree to that.
That was David Solomon, by the way, the CEO of Goldman Sachs,
who
in case you're
famously
wondering.
was a DJ.
I think once you were a DJ, then you're always a DJ. But that's cool. They do this video every year, right?
Yeah.
Last year you were in it.
I was in it, but I wasn't like speaking. It was just a clip of us saying how ridiculous the video was, and I was just laughing. So kind of them to exclude me from just laughing on
But it
on TV.
looked like a really serious production. Like,
this is the thing is, I mean, you can see John Gray like standing outside with a boombox, all these 80s references. I mean,
Knight Rider.
Ghostbusters, they spent a lot of money on this thing, right? Like the writing is, okay, it's hilarious. I watch it and I want to hate it, but I can't. It's actually really funny. But it just shows like this kind of kinder, goofier face that Blackstone is trying to put out there. Like, hey, come and day people, invest your money with us because look how like fun and honestly, it is funny.
I love it.
It is funny. It is really good.
Danny DeVito.
Oh yeah,
has a
Danny
cameo.
DeVito. Yes, and that is good.
And it's definitely worth watching, and it's on YouTube, so you can go ahead and Google this. And it's not private, you know, they made it public. So very cool stuff. In terms of markets right now, we are looking at gains after 4 days of losses on the S&P 500 as tech stocks drive us higher.
Yep, and CPI adding to that too as we come back from 4 days of losses. Coming up, alternative asset manager Luxus announces a first-of-its-kind investment fund. We speak to Dani Auslander, the company's CEO and founder. Stick with us for that conversation. That's coming up next. Christie's is backing a new kind of hedge fund as investors look for diversification. Alternative investment asset manager Luxus unveiling 2 funds dedicated to Birkin and Kelly bags, treating them as investment-grade assets. The first fund raised $1 million back in May and created a second fund due to overwhelming demand. Joining us now is Dani Auslander, Luxus CEO and founder. Dani, thanks so much for joining.
Thank you for having me.
As Matt can attest to, this is literally all I've been talking about for the past couple of weeks because I think this is so cool.
It's so fun.
First, how does this fund actually work? What exactly are you doing? Because it is quite unique in its structure.
It's just like a real estate fund. I mean, we're buying brand new Birkins and Kellys. We are, putting them in a portfolio. We have a whole portfolio construction methodology. We're using most of the bread and butter bags that are flipping over fast. And we're then selling them, and we're selling them both on digital marketplaces. So Sotheby's, First Dibs, My Gemma, Christie's just did an auction of a pink crocodile. And we're also selling them in real-life experiences. Experiences are all the rage now. So people want to learn more about Hermes and the bags themselves. So
that's interesting. So I've been excited about this since I heard about it too, because I have some friends who have started funds where they buy classic cars, for example, but they just then store the cars and never use them. You're actually trading essentially handbags, and I guess you're not going to Hermes to buy them new, right? You're buying them.
We're not buying them directly from Hermes, but we are using the resale industry, and there's so much pent-up supply in the entire range of bags. So brand new in the box with plastic still on, all the way down to the beater bags, which are very popular with the Gen Zs. So it's really been interesting to see what is popular now versus what was popular 10 years ago, 15 years ago, 20 years ago, and a bag sells every 48 hours.
Give us the price ranges. We're looking at some bags here. What's that, a Celine there?
That is a joke, right?
Yes, I have no idea. What are we talking about in terms of
bags.
They're all Hermes.
They're just Hermes, Birkins, and Kellys. It's a concentrated portfolio, and anything between, I would say, $25,000 to $32,000. And that gold one, which is the brown, is our bestseller. We've already replenished it 3 times, and it's really fun. It's been really great to watch it thrive so much. Fund 2 was 5x oversubscribed, so we're going into 2026 with big plans.
Forgive my fragile sensibilities when Matt looks at an iconic Birkin bag and asks if that's a Celine. No, but okay, this is not to pick on you, Matt. Yeah. But I wonder how much that plays into this, because to Matt's point, people have started funds around cars. They've started it around watches. And a lot of people would be surprised to know the kind of premium these bags build. And when I say a lot of people, I mean a lot of men. How much of the advantage here is just that this is an ignored asset class by 50% of the population?
Well, nobody's ever done a fund like this before, and when they've done the watch and the car funds, it's usually people from those industries. It's not asset management people like myself. So it's been, they don't know about asset liability mismatches, and they don't know how to price them, and they don't know how to structure them. So we're really excited about this fund because it's been really well thought out, and we have mostly men as LPs, including some of my Blackstone colleagues. So it's been really interesting to see. We have 2 women in Fund 2, but everybody else is a guy.
Yeah, come on. No one knows more about handbags and women's shoes than Tom Keene, right?
Yeah.
He's an expert on these things. And you mentioned your background in asset management.
Yes.
Where did you work before, and how has that really prepared you?
Yeah, I'm a Schulte lawyer from the late 90s. I've been in the hedge fund world for almost 30 years. I was at Blackstone for close to 10 years on the product development side in BAM. And I've been in the hedge fund. I know all the hedge fund guys. Many of them are invested either in Luxus or in the funds. So my superpower is to be able to structure alternative investments. So being able to do that for assets that I actually enjoy buying for myself has been a real joy.
To that point, because it's this moment where when putting together a portfolio, people don't know whether bonds have the hedging power they once did. Gold looks ridiculously expensive, and everyone is so worried that doesn't have much further to run. How much of the interest in your fund has also just been that people don't know how to diversify right now?
Exactly. It's a great diversifier. It hasn't been done before, so the returns are there. Fund 1 is up 38% gross, 28.9% net. Fund 2's already had 2 exits. We're still closing it. So I think it is really exciting because it's I'm very inspired by the real estate investment community and those asset management products. So we're doing that. Obviously, these are not fee-generating assets yet, but they might be.
What would that look like?
Well, I mean, look at all the Netflix shows and the Apple shows about wealthy people and escapism, like White Lotus and Your Friends and Neighbors, and you're seeing Birkins and Kellys displayed alongside watches and cars and everything else. So there's an opportunity to maybe rent the portfolio or at least sell the portfolio to the studios. And we're excited to work with them on that.
By the way, that brings up a question we were batting around in the editorial meeting this morning. Where do you keep these? Do you have like a bonded warehouse, or are security guards hanging around your office? And can you take one out to lunch if you need a nice bag?
No, I haven't even seen most of them. They are all being stored at My Gemma, which is our operational partner. They're being authenticated and evaluated and appraised by Graham Wetzberger, who is the OG and the best in this business. And we're taking it very seriously. It's the first institutional product, so we're trying to make sure that we're all set with everything.
Well, again, these bags have so much lasting quality and the value. Can you talk about the beater bags? Because I think that's really interesting. The idea that younger people like a Birkin that looks beat up, that looks very well used.
Yeah, Gen Z really likes the beater bags. I call it the Olsen effect. And they have been trying to get all the resellers to source them, because up until now, the resellers wanted to just source brand new bags or at least excellent condition. And now all of a sudden they're being asked to do the beater bags that are being sold for around $6,000 to $9,000, which is a much more acceptable entry-level price. And I personally love the beater bags. All of mine are as old and as beat up as could be.
You talked about during the commercial break how you got one with a bonus at a previous firm, and you still have it 20 years later. Do they?
Where is it?
Do they hold up?
Oh yeah,
I mean,
it's the same style that they're still selling today. That is going super fast. I got the first bag at Blackstone in 2005, so 20 years ago, with my VP bonus. And when I walked into the office with it, everyone was like, "How did you get one?" And so it's been a real, and they all remember the story still to this day. And it's been really fun for me to put together a fund around that.
Yeah, just because they're so difficult and so coveted, it is just like this magical thing, which I hear you might have a podcast about first bags coming out.
Yeah.
Which I think we should plug because that's so interesting too. I just wonder, as you think about the growth of Luxus, how much capacity does this have? How much can you grow it? And how much money do you think that can be managed under a strategy like this?
Well, for us, it's going to be about horizontal integration. So doing the same model with watches, with cars, with wines and spirits is really important. Next year, though, we're just focusing on this and going global. So we're going to plan some fun things with Christie's, both in the southeast of the U.S. and in the Middle East region, where they are really, really top-notch.
all right, it's a pretty fascinating subject, so I hope you come back. Dani Auslander there. The firm is called Luxus. Let's get a check on what's going on in the markets right now, beyond the luxury movers today. In terms of the S&P 500, since we hit our high at 69.01, a closing high last week, we've come down 4 days in a row of drops, leave us at 68.10 with today's 1 1/3% gain. The NASDAQ is up more because it's really the tech stocks and Micron specifically that are pushing us higher this morning.
Yeah, by the way, I'm looking to see if there's any reaction in Europe because Bloomberg sources just now reporting that ECB officials are saying that the rate cutting cycle is mostly over. You're still looking at a weaker euro, so not too much reaction there. German yields, again, little move this morning. It does seem like CPI is the more dominant force in markets this morning, Matt.
All right, this is a fascinating scoop by Mark Schroers and Alessandro Migliaccio, as well as Alex Weber, because remember, Christine Lagarde said like 15 times that she is not offering forward guidance.
That they didn't even debate forward guidance.
Yeah, so it looks like the European Central Bank now expecting the cycle of rate cuts to most likely be finished based on the latest outlook for growth and inflation. This according to the people familiar with the debate at which they did not discuss this.
Right, sure. Okay, let's take a look at some of the single stocks that are moving this hour. Instacart, we were just looking at that. Shares falling after a report that the FTC has sent the grocery delivery company a civil investigative demand.
Birkenstock shares falling. The footwear company forecasting slower growth as sandals and clogs contend with the impact of a weaker U.S. dollar and tariffs and maybe some tiny sense of fashion.
I thought Birkenstocks were cool again.
That was the case, and I don't think it stays
no
that
one's
way
buying
forever.
Those. We should buy. Donna, anyone buying those Dior Birkenstocks anymore? Are they over?
I don't know, but I just realized how similar it does sound to Birkins.
Yes.
Birkenstocks.
Yes.
Birkenstocks.
And yet such a different cohort, typically.
It's very true. Donna, great to have you on. By the way, just a quick look at CarMax warning that expects lower fourth quarter margins as it looks to improve price competitiveness, Matt.
Yeah, that's a fascinating story. Coming up, we're going to get a read on the markets with Jay Hatfield of Infrastructure Capital Management. He joins us next. This is Bloomberg Open Interest.
What we're starting to see is basically what looks like higher productivity in markets going forward. So what we're saying is that we're getting decent growth expectations in the future, but we're not getting a lot of inflation that's being associated with that.
That was Jim Caron of Morgan Stanley Investment Management. Joining us now is Jay Hatfield, CEO and Portfolio Manager at Infrastructure Capital Management. Jay, we've had, as we were talking about with Jim, a ton of data come out today and earnings, and ECB and BOE decisions. But I think the CPI is the most interesting because it's really getting lower if you buy, the figures. What do you think about it?
It's great to be back. Well, we've actually been predicting this for over a year because we do, as you know, we publish CPI-R. So we do real-time inflation using data from the internet. I don't know why the BLS doesn't do that. They should actually, we're going to bid to do CPI for the BLS because their methodology is pure insanity. But thank God, finally, their data is catching up to the market data. And this is really the heart of our bull case. Inflation, CPI-U, asymptotes to R, CPI-R. Inflation goes below 2. Fed cuts 3 times, not 2 times next year. Supports a 23 multiple, 8,000 target. So today's data was critical. We had 2 months of 0.1 shelter. It's still above our number, but 1% is going to get it. If we just print 1% annualized for the rest of next year, for all of next year, we will get PCE core as reported down below 2.
There's been a lot of commentary today and kind of, what you're talking about, how the calculations are odd and strange and maybe not to be trusted. The owner's equivalent rent has been a big factor in this. Omar Sharif from Inflation Insight going so far as to say, I'd fire someone over this, just how poorly it looks. So the official data, are you basically, you say it looks like yours, but is there an element where you're just kind of like, I can't trust this at all and I have to go in my own internal measures to try to get a read on where inflation is?
Well, yes. I mean, it would be easy to adjust, though, by us or anyone. So this is why, we were arguing for the Fed chair to be fired, because if you just looked at real-time housing data in early 21, you would have seen that inflation was headed for double digits. So this is why we think the Fed needs to be reformed, is they can't forecast inflation. Like, we're way better at forecasting inflation than they are. Not because we're geniuses, we just adjust the data accordingly. So they are massively incompetent and need to be reformed because they use this flawed data that anybody can see. They delay it for 6 months for no reason. It's as if you were reporting on futures 6 months ago. How long would you last doing that? That's what they do.
What do you make of the 10-year yield? Because you've also long had a call that it would come down. It has come down substantially this year, but if I put it up on a chart against Fed funds rates, right, since they started cutting here it is. Since they started cutting in September of 24, they've taken 175 bips out, and yet the 10-year yield has floated up 40 basis points. So when are treasuries going to catch up at some point, because we haven't really seen mortgage rates come down, we haven't really seen auto loan rates come down, and this is what you're trying to do when you're cutting at the front end.
Well, we think there's only really one financial condition you should follow, which is the 30-year mortgage. So it's below 630. It was as high as 730. So actually, long rates have come down dramatically. I've been on this program when the Treasury was at 480, and we said it was coming down to 4. And if you really track it, I wouldn't do the graph you did. I would do the terminal Fed funds rate against the 10-year, and it's tracked nearly perfectly 100 over. So this whole notion like, oh, Kevin has it, everybody's worried, just false. If that were true, then the terminal rate on Fed funds would be 2, and the 10-year would be 4. But it's actually ticked up recently. That's what drove the 10-year higher. It's ticking down, so I would be a buyer of treasuries here, because right now I think we're at 290 on the terminal rate.
That's right, 295.
Yeah, so you've got another about 10 basis points of tightening that's likely in the 10-year. So I would use that as your metric, not the current Fed funds rate. There's been a lot of disinformation, because what happens is the Fed cuts usually, or has happened. They cut, and then they put all those hawkish statements out, which drives up the terminal rate and makes the 10-year go up, and everybody's like, oh, that's inflationary expectations. No, it's not. It's just their dialogue is driving up the terminal rate. So you have to look at that terminal rate, or else you're going to put out bad information and bad analysis like that, oh, Kevin Hassett's going to be the worst Fed chair, when the data doesn't support it at all.
Are yields, though, drifting higher just not a problem in and within themselves, regardless of what the driver is? I had a conversation with Ken Griffin earlier this week, who said that it was a problem, maybe not for the here and the now, but if you continue to get this bleed higher in yields, it's a problem for capital formation. It's an issue for just frankly doing business and taking out loans for people who depend on it. In the long term, if you continue to get this pressure on the long end, does that not counteract what the Fed is trying to do?
Well, in our models, no, because if we do get the terminal rate to 275, so in other words, they could do this today. If the Fed chair came out and the other members and said, you know, we're kidding, we're actually going to do 3 cuts next year, not 1, the 10-year would drop below 4. So I agree 100% that the 10-year matters, mostly because of housing. Housing is in recession. Nobody talks about it. The 10-year is absolutely critical because it drives 30-year mortgages and auto loans. But what everybody's missing, sounds like including Ken Griffin, is that Fed speak matters. The 10-year is not blowing out because people are worried about inflation. It's blowing out because the Fed put out admittedly better than expected, but still hawkish commentary. They only have 1 cut, the market has 2. If they said there was going to be 3, the 10-year would go below 4. And very few people seem to focus on this, but the data just tracks that 100%.
By the way, you think housing is in recession, and as we get mortgage rates down, that's obviously going to help buyers. Is that the only variable that you're really worried about? Because there are fewer and fewer buyers, right, as the population demographics continue in this direction, and we have no immigration.
Mm-hmm. We do think that the key driver is mortgage rates, not the demographics and other drivers. So this is why, again, when the Fed lowered rates to 0 and continued quantitative easing, and the mortgage rate went to below 3, like all-time lows, they should have realized we were going to have massive inflation, because mortgage rates are the key driver, not demographics, not costs. If mortgage rates are low, people are going to buy houses. And it might be investors, too. We didn't add this 20 years ago.
But surely we get used to this, right? Because 6% is actually low for a mortgage, historically.
Right, and even if individuals can't afford it now, we have investors. They'll go buy the houses and rent them out. So the key, if you want to really call the economy, focus on monetary policy, and then housing is the key indicator. We are in recession, so it would be dangerous if the Fed stopped cutting rates, because the 10-year would go up, the mortgage rate would go up, the recovery in housing would stall.
All right, Jay, it's always awesome to have you here. Hope you come back, and thank you so much for joining us throughout the last year. Happy New Year when we get there. Jay Hatfield of Infrastructure Capital Management. Coming up, UBS is getting ready for another round of layoffs. We'll have more on the big Swiss bank, the only Swiss bank, next. This is Open Interest. UBS is set to begin its latest wave of job cuts next month. The move comes as it enters its final year of its historic integration of Credit Suisse, which it bought in 2023. Joining us now from Zurich is Bloomberg senior editor Jeff Black. And Jeff, this is a really fascinating story on so many levels. I said it's the only Swiss bank. Obviously, there are other Swiss banks, but it's the only big sort of global Swiss bank. And it actually gave, I believe, details of its staffing plans in Switzerland going out years, but it hasn't done that globally, right?
That's right, Matt. They've never confirmed any targets for job reductions overall as a result of the integration. Although there are targets for the amount of costs that they want to save overall. We have thought for a number of years that actually they're planning to cut about 35,000 in total combined headcount going through to 2026, and they're still a fair way off that.
Jeff, I mean, it just speaks to the enormity of the challenge of trying to combine two very large banks. In this, when they look at cost cuts, when they look at redundancies, they're still dealing with where are most of those concentrated?
So far, they've mostly been concentrated in the investment bank and the previous Credit Suisse investment bank. As you know, UBS's main business is wealth management, and that part has mainly been spared. But as time goes on, there's going to be a lot of back office staff that start to feel that. There's a big IT migration that's going on right now, and when that's done, we can expect that a lot of those people will be looking for another position as well.
So I wonder what the sentiment is like in banking. It does look like finance across the globe is doing really well. We've seen the stocks soar in Europe. They're doing well here. When these bankers leave UBS or even people in the back office, are they going to be able to find jobs somewhere else?
Well, it depends. I mean, the job market for bankers in Switzerland is fairly tight. And depending on the kind of role you're in, you may find it easier or not. But I think that the retraining that UBS is saying that it's willing to look at for people that are losing their current position, given all the massive changes that are going on in finance right now with AI and so forth. I think a lot of people could expect that they'll be doing something different in a few years' time.
I was going to say, Jeff, I'm surprised they haven't somewhere in here blamed AI, because it feels like everybody is doing that at the moment. How much of a change is that realistically at this moment making to UBS? And I guess the entirety of the banking system as a whole, is it actually impacting hiring plans yet?
Well, across Europe anyway, we've certainly seen that some positions are starting to slide because of the rollout of AI. But when it comes to UBS and Credit Suisse, there's a very big mechanical thing going on, which is two globally systemic banks are being fused. And there's such a huge amount of overlap there that that's a fairly straightforward story for now.
All right, Jeff, thank you very much on that. That is Bloomberg's Jeff Black in Zurich. By the way, we are expecting very shortly the launch of Blue Origin's latest rocket. You're looking at a live shot in West Texas of it. It's set to launch its latest crew of 6 on its flagship space tourism rocket. To date, Blue Origin has flown 80 individuals above the Kármán line, the internationally recognized boundary of space. Let's bring in Bloomberg Tech's Caroline Hyde. Caroline, what exactly do we know about this specific rocket launch, which we're waiting for in about 3 minutes' time?
It's on hold. T-minus 10 minutes. We're currently pausing, waiting to see if this will indeed go ahead as planned. This is New Shepard's rocket, the 37th, as we've been thinking, NS-37. It's the 16th human flight. As you say, there's 6 individuals on board this time. Actually, it's the first time that we ever see someone with a wheelchair go in across the Kármán line as well, so a significant step there. And it's its 37th overall that we've seen with New Shepard. And the rocket, remember, New Shepard named after Alan Shepard, who was the first ever American astronaut in space. It's about 60 foot tall that you're currently looking at, gazing on your screens. It's topped with what is sort of known as kind of a gumdrop shaped crew capsule. And that, of course, is what will then come back down to Earth, supported by parachutes a little bit later. They're only going to be about a ride of 11 minutes when they take off from West Texas, Dani. And it operates in completely autonomously. There are no pilots on board, but we are waiting to see whether indeed does go ahead as planned. So Matt Miller, Dani Berger, thank you very much indeed for what was another amazing stretch of time of the opening of this market with open interest.